Okay, so that's officially recording. So folks, well, Seminar 5, I just can't believe it's kind of halfway through the term. Well, almost already. It goes very, very quickly. This week we are talking about, and you are thinking about ratio analysis, systematic analysis of recent performance. So big picture, where does it fit in? Remember that, like, I guess from my perspective, our task is getting us to make better forecasts. So forecasting, which is what we talk about next week, is a really key component of what we do. Typically, when we forecast, we want to think about to what extent will recent and current performance change. That's really going to be the starting point of our forecasting. To do that, we need to have an understanding of what recent and current performance looks like. So that's our kind of our ratio or our performance or financial analysis that we're looking at this week. We didn't start off by looking at ratio analysis because we want to get a sense of what we might expect to see. And what we expect to see in our ratios is going to be built up by having an understanding of industry conditions that our firm's in, the way our firm is positioned within the industry, and the way in which both of those things are reflected and incorporated into the relevant accounting. So what are the accounting rules for the main things that our business does? So having that understanding of business strategy, having that understanding of what the industry conditions are like, will give us a sense of what sort of numbers we might be expecting to see, whether the numbers that we observe are kind of making sense or not. I said in the notes that return on equity is a common starting point. And there are a couple of reasons for that. Sort of one of the main reasons is the two main reasons. It's return on equity, net income divided by shareholders' equity, and we'll typically take that as the average value of shareholders' equity. So that's start of year balance plus end of year balance divided by 2. So income divided by equity, we can view as an accounting measure of overall performance from the perspective of the shareholders. So net income or a profit after tax would be our kind of initial starting point in thinking about this, because if you're a shareholder, the interest has to get paid and the tax has to get paid before you have a claim over what's left. We can then start thinking about tweaking the income measure to, well, what happens if some of my income has come from a one-off? Now, what happens if I had an unusual transaction? I've sort of sold off a part of the business this year. In that case, then you might start thinking, maybe if I'm forecasting next year's income, I'll take the component of income that is likely to be around. So we can start thinking about ways of modifying. But as a starting point, net income makes sense. So the overall measure of performance within the accounting system, so it's not affected by share prices, from the perspective of the shareholders. So that's one starting point. One aspect about that is that we can then decompose that into kind of measures that reflect what you as managers are likely to be doing in your firms to try and improve performance. So we think about the operating activities that get reflected in your profit margins. We think about the efficiency with which you use assets that's reflected in turnover. And we think about the extent to which you've got an appropriate or inappropriate capital structure, which is reflected in the leverage ratios. And so those things multiply together nicely, and we can talk about how they work together. So the fact that we can decompose it into components that reflect what you do as managers, or what we as analysts, kind of the perspective in this course, what we're looking at from an outside. The other thing that is kind of nice about ROE is we know how it behaves on average over time for large samples of firms. And that's this chart that I've got here. That we can even kind of create this chart if we want to. But in short, what this tells us is that on average, really high or really low levels of ROE tend not to persist. So I'll say that again, really high or really low levels of return on equity tend not to persist. That's helpful when it comes to our forecasting task, because if we're kind of observing really high levels of ROE, let's say MasterCard, for example, we then want to think about, well, to what extent is it kind of dragging the average up versus to what extent is it just abnormally high and will have to come down? We can think about this chart, I guess, at either the top or the bottom level. Let's think about the kind of the firms that have got at the bottom, and the way this is done. As I said, we could even do this kind of on the fly if we wanted to create this chart. I'll go to a database. I'll get the return on equity for a sample of firms, let's say in 2017. I'll get return on equity. I'll sort high to low. I'll then work out how many firms I've got and break it up into even groups, in this case, 5 even groups. I'll then calculate the average return on equity for each of those 5 groups, and I'll plot that. Then I will hold the construction of the groups constant and track what happens to average ROE of each of those portfolios going forward. And this is the pattern that we tend to observe kind of once things are cleaned up. Is that the way that's constructed making sense? Because if that's not clear, I can take 5 minutes and we can run through this and I can show you kind of from start to finish, using the database, how we do it.
I think that makes sense, but it means that you're not using the same companies every time, right? You're just using the top whatever. So there might be ones that like drop off, and part of the reason that it increases over time is because poor performing companies cease to exist.
Correct, absolutely. So if we're thinking about this bottom, so a couple of, the idea that you've got there, Braden, is that some companies, and in particular poorly performing companies, will exit, absolutely gets reflected in here. So I'm not kind of redoing my sorting on a year-to-year basis. I'm just saying, look, I'll take 2017, then once I've done my dividing into 5 groups ranked on ROE, I'll then track that same 5 groups for the following year. But some of the firms at the bottom will have dropped out, correct? What else might explain this increase in performance from loss-making firms in year 1 to, on average, slightly less loss-making firms in year 2? What else is it consistent with? Again, remember, this is an on average number.
Just the general business life cycle, and particularly with startups, you're often performing behind.
It could be. We've got a bunch of young firms in here that we know typically don't come to profitability until a couple of years into their, well, in this case, listed life cycle, because these are all listed companies. It used to be the case that you had to be profitable before you could float on the a stock exchange, but that kind of seemed to be dispensed with a number of years back. But yeah, life cycle is another explanation. That what we're observing, particularly in that bottom fifth, so the bottom 20% of firms, is companies that are just becoming more profitable as they go from start to maturity. Yep. What else could be the case? And I guess, let's say we started this exercise in 2020 or 2021, what could be causing poor performance in 1 year that then improves? So I was thinking of 2020, 2021 as a more general level, or I could pick on individual firms and I could say something like, I don't know, Qantas in 2014, Woolworths in 2016.
That like disruptions and business cycles, the sort of mini cycles that go through.
Yeah, I think that I think I'm agreeing with you, Anne. So it could be at a macro or an industry level. The 2020, 2021 comment was, we had a bad year because COVID hit our industry. So I was, let's say we're looking at a travel agent that was otherwise doing really nicely. COVID hits, no one travels. We are a loss-making firm in the year that I start this thing. And then we improve. So on average, kind of this improves. Yeah, it could be. So it could be, that's, I guess that's not really cyclical. That was a kind of an exogenous shock that we weren't expecting. but it could be cyclical in the sense that Qantas back in 2014 had to do a massive write-down of its fleet. Woolworths in 2016 had to do a massive write-down of the home hardware business that it was engaged in. So it's otherwise okay firms that have a one-off bad year and then return to good times. So so this bottom fifth increases. So that's at least three explanations for that. Bad firms disappear. Firms that are growing and coming to maturity are improving. And we had at the start of this whole process, firms that had a one-off bad year, but otherwise have got reasonable ROE. What about at the top end? So if we observe really high, so let's say firms or industries with really high levels of profitability, based on what we're thinking about in our industry analysis, what might we expect to happen?
I think one thing that could happen is within a business, like a diversified business, high profitable businesses would cross-subsidize sort of lower profitable businesses or new businesses in that group. So that could see the shift of capital.
So it could be internal capital allocation.
Yeah.
Would be one explanation. So on average, the business, so if we diversify rather than focus on the core business, and that kind of pendulum seems to swing and shift over kind of the decades. And what about at a more industry or market level?
The market would realise that there's a profit-making opportunity and competition would increase.
Capital we've got a bunch of smart bankers and consultants that would look at that and say, that's interesting that this company's earning really high levels of return. That's much higher than I was expecting. Maybe we should try and get a piece of that. And if we look at, say, Woolworths returns for kind of the 2000 to about 2016, they were all kind of much higher than you would expect based on the level of risk that the equity holders would have been taking. And that's part of the reasons why we had firms like Costco and firms like Aldi come in and start competing within that market, within, I guess, the sort of the more general retailing in Australia, while we saw firms like Zara and Uniqlo and so on all come in because it was kind of there was profits to be made. So the extent to which that's likely to occur is probably going to be a function of the competitiveness of the industries that we're observing. So what we still observe by the time we're up kind of year 10 is that we still have, the higher performing firms are still more highly performing, just not as much. So it's mean reverting, but they don't all come back to to one point. And so the difference is still likely to be driven, at least in part, by industry characteristics. So there's a couple of reasons why ROE is a good starting point. We can decompose it into useful parts, and we know, again, and I'll keep saying this phrase because I kind of don't want to mislead you in what it means. It's the large sample on average over time pattern of ROEs. Again, when you're thinking about your forecast that you're doing for your projects, if you get an ROE pattern that is different from that, it doesn't mean I have to change my forecast to get a pattern that looks like this. What you do need to do is think about to what extent can the industry and I guess more particularly the business conditions explain a pattern of ROE that varies from what we know tends to happen. So it's more thinking about, well, does this pattern look plausible? What would be the story that I'd be telling to convince the reader of the report that the story is plausible? So that's really what I try and stress about that you don't have to match this, but if you're deviating from it, then having an explanation is useful. And the explanation might be, company has a really wide kind of economic moat, and we believe that on the basis of that economic moat, it's effectively got barriers to entry that will allow it to keep earning high levels of profitability, at least in the medium term, probably the medium to long term. And here is why, based on my strategy analysis. And that's a perfectly legitimate way of saying it. Again, your strategy analysis would try and show what that economic moat was. I wanted to go back to let me just quickly do another show. I'll show you. Here's what hopefully you've now got. Can you see Braden's post with MasterCard? Yep. Okay, so we've got ROE 70, 110, 140, 105, 120, 140%. Now, if you go back and remember what the numbers were on that chart, sort of the high group tended to be about 40. So that's really high. And you would do what Braden did and say, huh, that seems really high. I'm going to go and check that. And part of what is doing that is driving that. I guess if we've got really high ROE, some combination of really high income or really low equity would be where we'd be thinking. Okay, so let's have a look through. Did that jump to the balance sheet? Yeah, no, yep, cool. Okay, I'll flick up slightly. So we've got, so here we've got MasterCard and we've got net income in millions, so 6 billion, 8.5 billion, 10 billion in 2020, 2021. Okay, so ballpark, let's say 10 billion. Let's just calibrate that. So 10 billion, if we're thinking kind of like an average rate of return, we're probably expecting equity therefore of somewhere in the sort of 70 to 100 billion would make sense to get us a 10 to 15% ROE. Let's scroll down to the balance sheet. Okay, 38 billion, 32 liabilities. Total equity is 6 billion. Earnings again, net income, after tax, after interest, 10 billion on equity of 6 billion. So that's what, so first up, Braden can look at that and say, okay, I didn't do a calculation. The ROE really is that high. And then we think about, okay, so equity of 6 relative to total equity and liabilities of kind of 38, it's around, yeah. This thing is really highly levered. So the level of assets relative to liabilities is kind of at about 5 to 1. So depending on how we want to measure leverage, assets divided by equity, ballpark 5 to 1. Now that's pretty high. The other sorts of institutions that have numbers like that are typically like financial institutions, the banks. So they will take money from their customers. So the cash that they get, which is initially an asset, and as far as the bank's concerned, the obligation to give the cash back is a liability. Then they need to try and invest that cash to make some money. And so they will loan the money out. So you've got mortgages, and the way that you typically run a bank is the interest rate that I charge on the mortgage is higher than the interest that I charge on my deposits. And so I make money out of my net interest margin in that sense. Part of what I need to think about as a bank, because this has come up over the weekend, is I'm typically taking short dated liabilities. That is, my customers have their bank account and they can take money out at any time, at least in theory. But if I'm trying to lend out, let's say on mortgages, they're typically 10, 20, 30 years. So we've got what's called a duration mismatch. And that's where I've got long dated assets, the mortgages that I'm writing, and short dated liabilities. And that's part of what managing a bank is all about, is trying to deal with that and to make sure that your mortgage book's rolling over regularly so that people can take their money out. You'll also have a little bit of equity in there, but typically the banks like MasterCard are also pretty highly levered. And so it's a balance sheet based business that you're trying to make a sufficient return off the balance sheet without running into this kind of duration problem. Now, MasterCard, I'm not suggesting it's not a duration issue that MasterCard are running here in the way that the bank is, and particularly the thing that was going on with the Silicon Valley Bank is that the people that it was banking to, and a lot of it was the tech companies and the VC crowd in Silicon Valley. They were awash with money that investors were giving them. So they didn't need to take out mortgages, and tech businesses aren't good for mortgages because there's no real assets that they can offer as security. So Silicon Valley Bank had to do something with the money because it wasn't lending it out as mortgages in the way that regional banks typically do. So what it was doing was buying things like treasury securities and mortgage-backed securities. So again, it had a lot of 10-year, 15-year, 20-year assets on its book. And again, this is kind of the duration mismatch. So once people started wanting their money, then they had to start selling some of these mortgage-backed securities and treasuries. We've all done some MPV calculations, correct? Yep, and we'll do some more when we get to our valuation. If I'm buying let's say I'm buying a US government bond, and I'm buying a 10-year bond when interest rates on government 10-year bonds are, let's call it 0.5%, and I buy $1,000 worth of bonds, and within 12 months, the interest rate on that bond has gone up from, say, 0.5% to 4%. Has the value of my bond that I am holding gone up, or has it gone down? Yeah.
Gone down.
Yeah, Thomas is saying down. Yeah, Bernie's saying down. Yeah. Okay, so we all understand how it's gone down. So as interest rates go up, if we're doing this sort of what's the net present value of the payoffs, it's a higher discount rate. So each dollar in the future is worth less in terms of dollars today. So as interest rates go up, the value of the bonds go down. And so this is the part of the problem that was happening with Silicon Valley Bank, is that its assets, that is the bonds that it had bought, were going down in value. And so when it had to start selling some of those to pay back, so when customers wanted some of their money, then they start recording large accounting losses. And then people take a look and saying, oh, I really don't like the amount of long dated bonds that they've got relative to their deposits. If a lot of people decided that they wanted their money out, then they could get into trouble. And that's exactly what happened. So I thought that this highly levered part was kind of relevant to the bank, because banks are highly levered, but normally you don't expect everyone to pull their money out at once. Mitch.
Just back to this example on screen, would a better ratio be return on invested capital or something like that to gauge a feeling for the total business rather than just a shareholder's perspective?
Correct. So this would be this is the perspective from the shareholders. It is kind of the oh, sorry, and I didn't realize we still had that up on there as our share. Yeah. So on the one hand, we've got return on equity. Now, if we're trying to work out what the level of income was relative to what the shareholders had, that's what it is. But you're quite right in suggesting maybe other metrics are going to be better metrics to get a sense of how well the business has performed. Now, let me just go, I've got facts set up. Let me go to MasterCard, and we can kind of have a look at that, and we will see. I'll try and make this large enough for you. And we can have a look and see if some of the other ratios are going to kind of, do they make more sense in terms of the numbers? And if we can get a feel for that, let me just make that a little bit larger. Okay, so we can see these numbers. Yep. Okay, so margin, sales, okay, per share, I'll go down. Okay, so I've got asset turnover low, margin really high. I've got a return on assets measure of about 26% compared with a return on equity of 145%. And so the return on assets measure, I think, is probably going to be a better reflection of the performance. And certainly when we're looking at banks, as well as kind of other sorts of financial institutions, return on assets, or it's going to be pretty close to return on invested capital, is kind of a modified measure of return on assets. Let's see if we've got a return on invested capital measure here. No, return on assets is the closest we've got on this link here. But yeah, so we're interested in this sense is given the asset base, return on assets is telling us what level of earnings we're generating from each dollar of assets in the business. And you're quite right, Mitch, in suggesting that that's probably going to be a more informative ratio than what level of earnings we're getting from each dollar of equity, simply because the thing's so highly geared, the equity is not really a good measure of the size of the business. And so
the return on invested capital is there if you scroll up, Jeff.
Is it? Oh, okay, yeah, okay. 47. Now that's still high. Yeah, that's still a pretty high return on invested capital. And if we can have a look and we can kind of say, okay, net income, yep, that was the 10 billion that we saw. Average total invested capital, 20 billion. So it's in between return on assets and return on equity. And sometimes people will use, in this case, again, if we're looking at a database, you want to be aware of how they've calculated this. So return on average invested capital, they've taken net income. You might see some people suggest that if I'm interested in the return on the assets or the invested capital, I probably am I don't necessarily want to see the impact of the way in which that invested capital is broken down, that is equity versus debt. In which case, a measure like earnings before interest is likely to be a preferred measure. And so that's why you'll often see people say, look, if I'm going to measure return on invested capital, I'll probably use a measure like NOPAT, net operating profit after tax, might be a better measure because that's quarantining the numerator from the impact of the financing decision. So I'll say that again. So if I'm looking at a return on assets or even a return on invested capital, you'll see a lot of people suggesting, and I think it's a valid argument, that you really want to quarantine the numerator, your income measure, from the financing mix. In other words, you want a measure of profit that doesn't include interest expense or financing expense. So again, so net operating profit after tax or NOPAT, it sort of fits the bill there. We'll come back to this when we're thinking about our forecasting, our cash flow. But is that, as a general concept, making sense?
Jeff,
yeah.
Question.
Yep.
Is there a source or sort of like guidance which ratios make sense for certain industries?
Yeah. The ratios, sometimes you'll see organizations like FactSet are going to highlight them. You want to think about it in this way. The starting point will be, what are the main things that my business is doing and what ratios capture doing that well or not doing that well? So I said, FactSet will give you a ton of ratios. Normally, companies are pretty good at working out what ratios are going to be useful or not. So if I'm say, I don't know, let's say I'm thinking about, I'll click on a stop share here. Let's say I'm going to my friend's JB Hi-Fi and I'm thinking, so what are they going to tell me? The place that I'm going to look for a JB Hi-Fi, I'm not going to go to the annual report. The document that I will go to that I think is likely to be more useful is typically going to be your investor presentation. So I'd always encourage you to have a look at that even before the annual report, because that's kind of where management bring together everything that they view as important. So let's have a look. Group overview. Okay, so here's how I kind of summarize the business. Okay, scale and low cost makes sense. Yep, multi-channel. Yep, makes sense as a retailer. Create and growth. Yep, okay. Sales, earnings before interest and tax, net profit, earnings, dividends per share. So no real margins there, but a little bit. But if we go to the divisional performance here, now we're starting to get into, we've got sales, so EBIT margin is probably going to be important for a retailer. But if I then click onto my next, so here's JB Hi-Fi, Australia itself. So what's going to be important for running a retail business like JB Hi-Fi? My gross margin, which is gross profit divided by sales, and also my cost of doing business. And that cost of doing business ratio is going to be all operating expenses other than the actual cost of purchasing the stuff that I sell. So cost of purchasing the inventory that they sell is captured in kind of the gross margin. So they're making kind of $22, $23, or sorry, 22, 23 cents on each dollar of sales. And in addition, it's costing them another kind of 11 cents for each dollar of sales on things like store rent, salaries, insurance, legal, all of that sort of stuff. Gets them an earnings before interest, depreciation, and amortization of the 400 million. So I'd say as a first port of call, go to what the company's telling you in the investor presentation, because they're likely to be focusing on the metrics that are meaningful, because they know that that's what the analysts are going to be after. As I said, and it will make, and it will vary by industry.
Mm-hmm.
So, as I said, retailers, yeah, gross profit and gross margins are really important. If I'm looking at other sorts of businesses, so it might be an operating profit rather than gross profit, because if it's a business where advertising and marketing is really important, I want to take into account advertising and marketing. Or in some cases, it might be R&D expenses that are really important. So I might even look at R&D relative to sales, and or R&D relative to, or advertising relative to sales. In some businesses, we're selling a lot on credit, and collecting the cash is really important. So I might focus on some of the accounts receivable based ratios. So it might also be kind of accounts receivable turnover. Obviously for sort of JB Hi-Fi, I'm going to be interested in ratios like inventory turnover as well. So it's, if you think about what the business does, think about the main things that it is doing. What are the ratios that are most likely to be capturing whether it's doing those things well? As I said, certainly be guided by what the firm itself is telling you, because that's, as I said, they're going to be focusing on what's going to be important. So I say, in addition to what we've got here for JB Hi-Fi, I'd also be looking at inventory turnover, as well as kind of accounts. Yeah, they're not selling that much on credit, so accounts receivable turnover is probably not that important to me. And maybe accounts payable turnover if they're stretching out their suppliers or not. Mitch.
Sorry, guys. I just got to share an example where in business we used to we were good at sort of selling ourselves to senior management about how good we were, based on how good we went compared to last year. And until I took this course, I had no idea how to actually assess my business against the sector and the industry that I'm in. So I think that's very useful as well, because a ratio that looks good in one industry may not look as good in another. And so it's not just the ratio itself, it's the benchmark and the comparison to something that's, and for me, we steered away from that stuff because we didn't like to compare ourselves too much with the opposition, who are often better than us. So I think that's I guess another insight from this unit for me, how important it is to compare the ratios with other businesses that are similar in the same industry and similar size.
Yeah, and look, thanks, Mitch. And part of a typical question that always comes up in this kind of, well, ratio week is, well, what is a good number? And my response is always going to be, well, it kind of depends on what your business is doing and what the life cycle is and so on. A couple of resources, well, some resources that obviously FactSet is a good resource because, again, well, I'll go back to that in a second. FactSet's a good resource because you can kind of get a quick sense of industry. For us, there's probably more data out there on US-based firms because it's just kind of more public analysis. In the additional readings, the first document that I put up on this week's materials is this document called Australian Financial Reporting Benchmarks. And if you kind of click on that, well, let's see if this opens up. Hopefully this opens up for you. And, oh, I've made you go down. Okay, sorry, I thought I'd given you the actual PDF. Let's have a look. Oh, where will I dump this? Just dump this to the desktop. So what this document is, for those that haven't seen it, I know one or two of you have seen it in a previous course. It calculates sort of typical ratios by industry code and also sorts by size, because we know that for certain industries, large firms look different to medium firms, look different to small firms. So if I go down, let's say I want to look at JB Hi-Fi's in consumer discretionary. So if I go to page 35, scroll to page 35, I will see consumer discretionary. If I go to the large caps, here's what I can get. Revenue growth, what's low, normal, high, very high, what's the average, and some global numbers as well. What's typical gross profit margin, what's typical EBIT margin, what's typical cost of debt, what's typical return on invested capital, ROE was kind of high. Was that, oh no, the normal 15%, even that's kind of high. And we've got some working capital ratios, and we've got capital investment ratios, and we've also got sort of typical leverage, so debt to equity, debt to assets, and so on. And then we've got the same set of ratios for medium-sized firms, and then we've got the same set of ratios for small firms and so on. So for Australian firms in particular, this is a really useful resource. You can construct the same thing yourself through the data analysis database or FactSet. The way you would kind of do that, let's say we were looking at, I don't know, MasterCard. Have we now got the FactSet figures up? We can see that. Yep. Okay. So if I want to have a look at, let's say I'm interested in how MasterCard has gone, what I'm going to do, I'm just going to click on industry up the top here. So I'll click on industry, and it's going to take me to the industry that's associated with the company that I was just looking at. So if I did JB Hi-Fi, it would take me to Australia electronic goods retailers. But because I was on MasterCard, it goes miscellaneous commercial services. And I might then say, okay, let's have a look at return on invested capital. That's 8, which is kind of lower and more typical. I'll click on that, and then it will give me a list of firms that it's lumped in miscellaneous commercial services. And I can kind of work out whether I think that this is a useful or not a useful kind of set of benchmarks. So that's another way of getting to benchmark firms, at least as the FactSet kind of analysts have classified things.
Hey, Jeff.
Yeah.
Yeah, just follow-up question here, because as you can see, it incorporates a lot of companies, and
yes,
I would think like some companies probably not relevant at all.
Correct.
So would it be better if we create our own peer groups?
If you think that creating your own peer group is going to provide you with a better comparison, then that'd be a great way of doing it. And again, I'll step back and think, what are we trying to achieve in terms of a big picture here? What we're trying to achieve with our ratio or our performance analysis is getting a sense of how well our business has performed given the industry conditions and given its competitive strategy. So the better the peer group is to compare with, the better the sense I get whether it was, well, it was just a really good year for everyone, or a really good year for my industry, or no, my actual business kind of outperformed or underperformed a set of firms that I'm pretty confident were doing the same sort of thing. So the best peer group will be a peer group that allows you to get a sense of whether the firm you're looking at has done well, has done kind of as expected, or has underperformed. And again, you kind of ideally, your peer group will have similar sort of suppliers, similar sort of customers, similar sort of risks, and similar sort of key success factors, as in they're doing similar sorts of things. And that's what industry is meant to capture. But as you pointed out, Moni, that list that FactSet had there had a whole bunch of companies that probably wasn't doing exactly the same thing as MasterCard. So a couple of ways that you can approach this as an analyst. What you might say is, look, if I'm MasterCard, I know what my main competitor is. And I'm probably not assisting Braden too much with the project if I say its main competitor is Visa. So I don't think that's kind of a big giveaway. So you might want to do I will compare with Visa, but because either MasterCard or Visa may have had an unusual year, I'll also compare with a broader industry mix. And that might be one way of doing it. If we think about what the analysts do, analysts will typically follow around a dozen or so firms from a given industry. So you kind of want to think about what's the best way of setting this up. And one way, if you wanted to do that, is if you're looking in kind of your, in the research tab up the top, and then you can set up screening, and you can start setting up your own screens based on particular companies or particular industry characteristics, and then select what sort of metrics you want here. So here I can start specifying companies or indices or particular, so firms, indices, or broader market metrics, and then kind of I can get sort of typical type of ratios that I'm looking at. So you can use FactSet to, in effect, piece together your own industry or your own benchmark, if you think that's likely to make your job a bit easier. Again, the task is, how do I explain, or how do I best show whether my company has performed well or not? So what's a fair performance comparison? And that's really what you're after. Is that making sense, Moni?
Yeah, absolutely.
So we're thinking, okay, so return on equity. So I said, then we'll typically start decomposing that. So we'll decompose it, as I said, into typically think about profit margin, turnover, leverage. So profit margin, we're thinking, to what extent are we able to generate income out of each dollar of sales? So thinking about kind of our revenues and expenses. Turnover is thinking, so the turnover, the efficiency with which we're using our assets. So for each dollar invested in assets, what level of revenue am I able to generate? And then leverage, so that this kind of balances out, we need to measure leverage as assets over equity. So we end up with income over equity once we kind of cross out sales and assets. So what's the ratio of assets versus equity? Now, as we saw with MasterCard, that's really high. And so that's why it's kind of driving up the overall return on equity. So if I go back to, I'll share that ebook. So if we've got, so margin times asset turnover, this is what we refer to as return on assets. So this is a measure of return on assets. So I can cross out sales and I've got net income divided by assets. So I said an alternative way of measuring return on assets that you might prefer is NOPAT, net operating profit after tax, divided by assets. But part of what I hope you get out of this course is an understanding that there are different ways of measuring the same sort of concept, and just to be aware of what this is picking up. So what this is picking up, this net income, is picking up the interest and the tax. So that might, or it might not be, an appropriate thing to include. Let me go back to, let me cross out there. I'll go back to, hopefully, we're back to JB Hi-Fi, and we've got divisional performance. Let me go up one here. If I go back here, can we see HY23 divisional performance? Yep, good. Okay. If I'm running JB Hi-Fi Australia, or I'm running JB Hi-Fi New Zealand, or I'm running the Good Guys. So let's say I'm the general manager of each one of any of these divisions. Then I may or may not, I probably, if we're assessing my performance, I probably don't want you to take into account the way in which the JB Hi-Fi group overall has set up its borrowing. Because if that's done at corporate level, that's really not something that I've been controlling. So the JB Hi-Fi group borrows money and allocates it to divisions as they see fit. So that capital allocation decision is an important part of managing a group with a number of different divisions. But if I'm running JB Hi-Fi Australia, I'm probably not doing the borrowing myself. And so I don't want to be rewarded or penalized on a measure that includes interest. In the same way, JB Hi-Fi, the group, is going to be taxed as a consolidated group. So JB Hi-Fi New Zealand and Good Guys is going to impact on the overall tax position of JB Hi-Fi. So that's why we see a measure like EBIT, earnings before interest and earnings before tax, as a performance measure for these divisions. And it's why, if you go and have a look at the remuneration, you will see that they're rewarded on a before interest and before tax measure. Yeah, and so the reason, because these divisional managers or the divisional MDs, they don't set the borrowing policy, they don't set the tax policy for the overall JB Hi-Fi group. So that's not relevant to their performance. What their performance is important is generating sales and generating profit, kind of gross margin and operating margin on those sales. So again, that's why we'll have different types of ratios will come out kind of depending on what we're trying to evaluate. So if I want to evaluate how well we're utilizing all of our assets, return on assets, or an asset turnover. If I want to quarantine the effect of how those assets have, well, what happens if some of those assets are not really operating assets? And did we talk about, say, Apple's balance sheet at the start of the year? Okay, I've got, let me go back to, let me go back. I don't want to go there. I'll get Apple up now. And if I go to Apple's balance sheet, then I might want to say, MasterCard. Now I'll go Apple Inc. Let's click on that. Let's look at balance sheet. If I look at Apple's balance sheet, I can see total assets at the most recent year, 352, and that's in, I think it's 352 billion. And of that $352 billion in assets, cash and short-term investments is 50.
You're not sharing your screen, Joe.
Am I not sharing my screen? That's not very helpful, is it? Thank you. There we go. Is that better? Can we see Apple now? Okay. So what I was looking at, we've got total assets of 350 billion. And of that, 50 cash and short-term investments. So that's treasury bills, corporate bonds. We've also got $120 billion of other long-term investments. So we've got kind of $160 billion worth out of our $350 billion of things that really don't tell us about Apple's capacity to generate earnings. And so this is where you might say, I might want to exclude that from a measure of operating assets. And so this is where we start thinking about operating versus financing type items. And so that's where that alternate DuPont methodology comes from, as the idea that, not all assets are the same. Again, Apple's a kind of weird one because it does a lot of its manufacturing is offshore, and it subcontracts that out. So if you look at its, say, asset turnover and inventory turnover ratio relative to, say, Samsung, those two companies look quite different because of the difference in business models.
So is it, you wouldn't want to necessarily completely discount that though, because as much as like when you're trying to benchmark, it might cause some confusion. It's probably an important part to how they generate and expect to continue generating profits is through those investments.
Yeah, absolutely. And one way of doing that, as I said, we can do this or treat this in a number of different ways. I guess a concern that we might have though, Braden, is that particularly in the last 5 to 10 years, the expected return on cash and investments has been tending to zero. Again, up until the last 6 months. Apple's expected profitability on the stuff that it sells is not zero and is a long way from zero. And so part of what we need to think about is, okay, so of that 100, what's the expected return on the $160 billion of low yielding things that they hold versus the rest of the assets that they hold? And so separating it out in that sense is useful because it gives us an idea of what we might expect them. It gives us a better benchmark for forecasting, I guess, is where we're going. And we want to think about, okay, so I guess another concern might be $160 billion. That's kind of a lot of money to have sitting about. And my concern might be, based on what I've seen companies do in the past, I might be worried that they will overpay for acquisitions if they're sitting on that amount of money. So they may not be disciplined with their capital allocation if there's money sloshing around. And there's certainly some research out there that suggests that the more kind of free cash or excess cash or free cash flow that you've got, the less that's valued. So people will try and do a valuation of businesses like Apple and say, look, I'll value the operations and I'll see what's left. And it turns out that the cash and the investments are valued by the market at less than 100 cents in the dollar. And the reason being is that I'm worried that you're going to waste it and you're not going to spend it well. And from a shareholder's perspective, if I was a shareholder in Apple, I'd probably say, can you maybe give, I don't know, 120 or 30 billion of it back to us in the form of a buyback so we can allocate it more effectively? That's what I would be hoping for. Now, there are some underlying US-based tax reasons why Apple and a lot of other international tech firms have these huge investments, but it's but not the whole reason. But yeah, back to your point, 100% you would want to take this into account, because it's going to impact on your forecast. You think, well, I know Apple can generate, say, returns of margins of 40%, but it can't do that on 20-year treasury bonds, okay? Because they're simply not yielding 40%. Yeah, and so you want to separate out the parts of the business that are going to earn a really good return versus the parts of the business that aren't. Mitch, you had a question, observation?
Look, it's probably not material, but I think does it understate the return on equity then if they're holding all this cash that they could have bought back the equity?
Yeah, correct. So yes. So if assets are overstated by all of this investments that they've got, then equity will also be overstated. Yeah. And so a return on equity will look worse than it otherwise would be the kind of the thinking that we would be going through in terms of getting there. As I said, one way of doing it is to value the company without the cash and without the investments, and then add the value or whatever percentage of the value of the investments we think is left. So I'll value everything else. I'll value everything else so value the operations of Apple, then I'll add what I think those cash and investments are worth. And I might say, you know what, Apple have been relatively disciplined. I might give you 90 cents on the dollar there. So I'll value the company, then I'll add the 160 billion and so on. So that's one way of going about doing it. But yeah, all else equal, having a large amount of assets that are generating a lower return than your operations are will understate the business's return on equity. Yeah, as I said, and this is what gets to that DuPont and alternate DuPont decomposition that I went through in the notes. So back in the ebook, then one of the, as I said, the issue is that if we're just using the standard DuPont decomposition, then we're not taking into account that difference in assets. And that's what comes down to that alternate DuPont decomposition. When would that be helpful? Okay, so it might be helpful if your business has a large amount of non-equity funding. So that's the kind of the thinking that you'd be going through. So when will separating out operating and financing make sense to me? If there's a large amount of financing is the answer. If there's a really low level of financing, then it probably doesn't help, doesn't make much of a difference, because the operating or the return on assets is going to be matched by the return on equity. So if there's not a lot of borrowing, as I said, then you may run into a different problem, is if you have a lot of so investment assets but not operating assets, and again you can separate those out as well. And I can kind of whack up a slide to show that. But is that kind of thinking making sense? So thinking about overall profitability, then I can decompose that into measures that are useful, and within there, so within each profitability or within each efficiency measure or within each leverage measure, there will be other things that may well be important. So within profit margins, it might be selling general and admin might be a real focus for my business. It might be gross margins. It might be some other sort of operating expense that I will kind of drill in on because I know that's important. And within the asset turnover, it might be inventory turnover, or it might be long-term asset turnover. It might be how well am I using my property, plant and equipment and so on. So different businesses and industries will lead you to be focusing on different components of those kind of primary margins, turnovers, leverage type metrics. The other thing that I just wanted to flag about margins and turnover that I thought I had in the workbook, and if not, I will pop it up. Oh no, it's not. It's in the actual notes. Let me go back and I'll show you what I'm talking about. We know how margins and turnovers tend to work together. And what we know is that businesses with high levels of asset turnover, high levels of asset turnover, which is kind of like the ones up here. So here tend to be the ones with low levels of profit margin. And the converse applies, so that the businesses with low levels of asset turnover tend to be the ones with high margins. We can think about either end. Let's think, so top left, where we've got health services, pipelines, water supply, pulp mills, and so on. These are, what would you say characterizes all of those sorts of businesses? I mean, other than obviously low turnover, high margins, because we can see that.
Non-cyclical?
Yeah, kind of non-cyclical. And what else do we need? So if I'm
fixed assets.
Yeah, large fixed assets. So I have to put up my hospital. I have to build my pipeline. I have to build my water supply. I have to build my pulp mill. So I will have a large level of property, plant, and equipment or fixed assets on my balance sheet this year, and also next year, and also the year after. So by their very nature, these businesses will have high levels of fixed assets or high levels of assets on the balance sheet. So that's why it won't surprise me if I see low levels of turnover, that is sales, for each dollar of fixed assets. Now, going back to what we said about industry characteristics, once I've put my hospital in a location, or my petroleum pipeline in a location, or my water pipeline in a location, and we're thinking about industry and competition, what might our expectation be? Petroleum pipeline goes in. Tell me about either what happens or more particularly what doesn't happen.
It'll be operating for many number of years.
Yeah, operating for a number of years. And what else? So what else is what else in particular is not likely to happen if I have my petroleum pipeline servicing a particular area?
The chance of somebody putting a pipeline next to yours?
The chance of someone putting a pipeline in next is relatively low. Yeah. And sometimes that's just going to be scale economics. Sometimes it's going to be regulatory. But yeah, we've got a barrier to entry is typically what we've got. So we've got some sort of natural monopoly happening, or quasi-monopoly. That then allows you to generate a sufficient margin to try and recoup that capital investment that you've made in the petroleum pipeline and so on. And so that's kind of why we observe the patterns that we do. At the other end, at the kind of bottom right-hand side, we've got our grocery stores, so our Woolworths, where if we think about the snapshot that the balance sheet gives us at the end of each year, part of that is we're on a kind of a big component for Woolworths is going to be its inventory and kind of any kind of leases that it has on the stores. The whole business of your grocery stores and the wholesale grocers is to sell each thing that you've got at any given point in time lots of times. Okay, so I expect a high level of sales and remember, this is for each dollar of assets when I take the snapshot that the balance sheet is taken on. Now, the flip side of that is I'm prepared to take a low profit margin because it's a volume-based business. So these two things kind of tend to work in opposite directions. What we do know is that it can be difficult for organizations that are being run well to improve both margins and turnovers at the same time. That tends to be difficult because often what will improve turnover kind of, I don't know, how can I improve sales for each dollar of assets? Well, I could discount. Okay, but that lowers margins and so on. So it's hard to, it can be difficult to improve both at the same time if you're coming from a relatively well-managed business. If it's a bad sort of like a turnaround business, then it can be done. So again, just be thinking about that in terms of the forecast that you're making. Kashal.
Jeff, why are hotels on the bottom right? I would have thought that they'll be similar to hospitals.
Oh, yeah, sort of similar to hospitals, except if we think about, say, the Sydney hospital. Are you in Sydney, Kashal?
Yeah.
Okay, so think about the number of hospitals in Sydney versus the number of hotels in Sydney. Okay, and think about what we're doing to our hotel bed. We're flipping, so we've got far more hotel beds and we're flipping them far more often. So there are, in terms of the amount of space, we've got more beds per square meter of space for hotels than we do for hospitals. And we're flipping them more, is going to be the argument. And so we've got more competition because there's normally you can put up, certainly you can get private hospitals and government hospitals, but there's far less competition within the hospital market than there is within the hotel market. And again, with the hotels, are kind of sort of selling them every night, as I said, in a more competitive process than The hospitals where kind of under our kind of Medicare system, there's at least some form of government paying. So it's a slightly different. This happens to be US data, but the same logic is going to apply here. So hotels and motels, you're flipping the product more often than you would be in the hospitals. And if we think about the level of investment, so if I'm building a hospital versus building a hotel on the same footprint, what's going to cost me more money? Hospital. That's going to be reflected in higher property, plant and equipment, and therefore all else equal, lower turnover. Yeah, so a number of characteristics about those marks mean that sort of, even though they're both kind of, we're whacking up a building and in effect selling beds, the dynamics of the industries are a little bit different. The fact that high CapEx businesses this year, or businesses with high levels of property, plant and equipment or fixed assets this year, will tend to have higher property, plant and equipment next year, means that on average, asset turnover tends to move more slowly than profit margins. So asset turnover tends to remain more stable than does profit margin. Let me just see if that's what we found. And I'm just going to have a quick look through. Okay. Okay. QBE, slightly different because asset turnover is not really going to be the key measure. And again, here we're driving by what's important for the business. So insurance ratio or insurance margin combined ratios and leverage is more important than asset turnover, because it's, again, insurance is like we were discussing with the banks earlier. I'm taking insurance premiums from my customers. I need to forecast expected payouts, and I will invest those premiums in assets that I hope are going to have a payment structure or a payoff structure that matches my forecast claims. So that's the nature of the business, rather than using assets to generate sales as such. It's more meeting the expected claims. Okay, so we've got, where's asset turnover bouncing about? And I guess one interesting thing that Michelle might be able to tell us about when she does the final report is thinking about what led to that large jump in asset turnover in 2022, because that's not something that we normally have. Michelle, you may or may not want to jump in now. I don't expect.
Sorry, Jeff, that's the wrong one. I've got the follow one.
Oh, okay.
Yeah.
Even okay.
Yeah, but
it's almost proving the point. That's
Yeah.
less bouncy than that one. Okay, so that one makes me think, oh, that's unusual.
Yeah,
Now,
I checked the data and I found out there was some mistake.
Okay, so that's more stable. Yeah, which makes more sense. And where's that? Okay, here's a bit more bouncy about, and this could be we're going right to left, not left to right. Yeah, so it might be, I wonder what happened in 2019 that caused that asset turnover to decline, because it's kind of non-trivially lower than we observe in other years. So again, that's something that Chantal might want to think about in terms of explaining those numbers for the final report. As I said, but it tends to be and here's Domino's is bouncing about a lot. So again, okay, so what happened in 2019? So here you say, look, this tends to be flatter. What happened in 2019 would be the question. And okay, so stable, managed to increase a little bit in 2022. Maybe that was kind of sort of a post-COVID. But I guess the point that I'm trying to highlight here, just taking your operating, that kind of is that's a relatively steep decline in asset turnover. Again,
if sales go up, Jeff, does that make a difference?
Yeah, if sales go up, and particularly if sales go up and we're on a large CapEx business, then yeah, that's obviously going to be driving that asset turnover and the operating asset turnover, because as I said, the operating assets themselves tend to remain fairly stable. And so if they manage to kind of have a much better year in terms of sales in 22 than 21, that's the explanation for what's going on there. Yeah, so I guess part of what I was trying to highlight is that on average, asset turnovers tend to remain more stable than margins, which bounce about a bit more. And again, on the basis that a high capex business this year is going to be a high capex business next year, and that's going to be reflected in your asset turnovers. And similarly, a high turnover business this year is typically going to be a high turnover business next year. So what we're trying to do is get, as I said, get ourselves set up for forecasting and to try and work out what are going to be the key ratios that explain performance? What's a good set of benchmark firm or firms that we can do to best show that? And as I said, then thinking about what measures of performance are likely to be helpful or not helpful for us. One issue that comes about is what happens if I can't find a good comparison firm in the country that kind of my firm of interest is operating in. So I said, this tends to happen if you're looking at Australian firms, you can kind of run out of good comparison firms pretty quickly because it's a relatively small market. I guess an obvious thing is you go overseas. What's a potential issue then, or what are some potential issues that you might want to consider if you have to compare with firms that are kind of operating in or reporting in different countries?
And tax treatments and accounting requirements? Yeah,
it could be country level differences might be explaining the differences in performance. And so it might be, if I'm comparing, say, Europe and US, or US and Australian, we've got two different sets of rules. So we've got US GAAP and we've got the international rules. Depending on what your organization is doing, that might lead to different accounting treatment. And so you might want to sort of have to flag, hey, look, reader, this is the best company for me to compare against, and here's why, and here's why should be something along the lines. It's the company doing the most similar things to my firm. But here are some of the differences, and the country level differences could be they don't do their accounting for inventory in the same way. So in the US, you can use LIFO as an inventory valuation, so last in, first out. Whereas under the Australian rules, you can't use last in, first out for your inventory sort of cost flow assumption. You have to expense all R&D in the US, and you can capitalize the development expenditure. So there are certain differences, and you just want to kind of flag, look, I don't think these are going to matter, or these might matter, and here's where you would look out for the impact. And so again, look, if a country difference or a firm in a different country is the best match for you, then so be it, it's the best match, and you kind of just explain that, but don't shy away from the issues that gives rise to. It's kind of just a note in the report, hey, look, things other than, so I guess this is the point, things other than the performance of my firm or the management of my firm might be causing some of the observed differences in these ratios. And that's really the point that you want to be highlighting, Mitch.
Just something that everyone else might have bugging them. When you say it's important for us to know about ratios to determine the valuation and the forecast, why would we place too much emphasis on accounting numbers if our ultimate forecast is to generate a cash position that I think if we're trying to value these businesses, why are we placing so much emphasis on accounting numbers and restated accounting numbers to get to the ultimate end game here?
Okay, so this is where we're going next week. And that's a good question. So if I'm doing, let's say I want to value my business off, let's say I want to value it from the perspective of shareholders, so equity holders, and I want to use a DCF model, so a discounted cash flow. So I'll be using a discounted free cash flow to equity holders is going to be the metric of interest to me. So the question that you're implicitly asking there, Mitch, is how would I be, or what role do accounting numbers have in my forecast of free cash flow? Is that a fair way of restating the question?
Yeah, you do a lot better than I do. Yeah, sure.
Yeah. So, and that's a really good question. And so why would accounting-based ratios be important in doing that? What we'll see next week is the way in which we generate our forecast metrics that we will use in valuation, be it free cash flows or be it an earnings-based model, is via the income statement and the balance sheet. So we won't be forecasting cash flows directly, that we will be forecasting them out of income statements and balance sheets. Let me show you what I will pop up kind of in the next 24 hours. Can we see my JB Hi-Fi forecast here? Okay, so here I've got, and I haven't updated, this is what I was forecasting kind of about October last year. So I reserve the right to change these numbers, but I'm forecasting sales growth because I think sales is important. I'm going to be forecasting. So let's think about what I'm doing here. I'm forecasting sales growth. So given the existing level of sales, that gets me my revenue number. So that gets me, I'll make this a little bit larger for you. So that forecast row 21 here, sales. I'm forecasting a profit margin, and I'll forecast operating profit margin. And that gets me, given the level of sales that I'm forecasting, net operating profit after tax. I'll forecast these two rows here. They're the inverse of my turnover ratio. So rather than sales over assets, it's assets over sales. And the way to think about this, rather than asset turnover of 7 or 8, is I'm now saying for each additional dollar of sales, I need 17 cents worth of investment in operating long-term assets, or I don't need any working cap because working cap stays about 0. So this is saying for each dollar of sales, what's the percentage number that I need in long-term and short-term assets? That forecast, given sales, then allows me to forecast these balance sheet numbers. So I get the size of the balance sheet numbers. The after-tax cost of debt allows me to get my net interest expense, and my leverage ratio allows me to apportion these net operating assets to debt or equity. So out of this set of ratios alone and the existing position of the firm, I can come up with a condensed balance sheet and a condensed income statement. The way I can conceptualize free cash flows that is consistent with a dividends model, which we know from finance is important because the value of an asset should be the present value of the expected payoffs, and the expected payoffs from a share as a dividend. I'm going to forecast or conceptualize my free cash flows to equity in the following way. I really want to think about what have I got available to pay out to the shareholders after I've done everything that I need to do. And so what I've got is I've got my net income, but if I'm forecasting the firm to grow, some of that net income has to go to working cap if I've got a positive ratio up here. Or if I'm forecasting my firm to grow and I'm say JB Hi-Fi, some of that net income has to go to fund additional store expansion or additional purchase. So this could be additional purchase of inventory for online, or additional store expansion, or additional investment in back office equipment or so on. So I'm not going to be able to pay out all of my income in the form of a dividend if I need some of it to fund CapEx. So I'm going to take into account the change in the size of the business that I'm forecasting over the year. I'm also going to be taking into account whether I borrow or pay back any debt based on what I think about is happening in capital structure. So the way that I'm going to be generating, and I'll try and convince you that this works in the next week, the way that I'm generating my free cash flow forecast is coming out of forecasts of income statement and balance sheets. And that's why it's going to be important for us to be thinking about those kind of accounting or financial statement ratios, so income statement and balance sheet ratios, because it makes sense to forecast as a starting number sales. Then how do I get sales, which kind of helps me get the income statement, and then sales, then how big does my business need to be to support the sales that I'm forecasting, which is the asset side of the balance sheet, and then how am I going to fund that, which is the liabilities and equity side of the balance sheet. And out of that, I'm going to be able to get, well, here's the available cash that I could distribute to shareholders in the form of a dividend. So that's
you're variabilizing the balance sheet with the changes in the sales and operational.
Correct. So everything here is being driven by the starting point is always going to be, what do I think is next year's sales or the following sales? And then how do I think I'm going to get that increase in sales? So is it a change in margins, or is it because I'm going to have more assets in place to generate the sales? And so we kind of start building up our forecasts in that way. As I said, that's the kind of the 3-minute explanation of what we'll go through in the next 7 days. But as a kind of a high level concept, is that kind of making sense? The other thing, the other way, because what we're increasingly seeing is people focusing not just on equity value, but on enterprise value or kind of asset value. If we wanted to adopt the same approach to valuing the enterprise, so that is, I don't care how it's financed, I just, rather than buying 100 shares in JB Hi-Fi, I want to buy JB Hi-Fi, the business. I'm going to take it private. I'm going to run it myself, like Elon did with Twitter. So I'm interested in the profitability of the underlying assets, and I don't really care about the equity because I'm going to take it all in and I'm going to pay off any debts, or I will rearrange the financing myself. I can do the same thing valuing enterprise here, where I'll take, rather than net income, I'll take an operating profit as my starting point. Rather than taking, so I'll take into account the changes in the balance sheet, but I won't take into account changes in net debt because I'm indifferent about the debt versus equity funding mix. So I'm not interested in interest being paid, and I'm not interested in changes in debt, but it's the same underlying logic that I'm going to apply to generate a free cash flow to the enterprise. And what we'll be talking about in the coming weeks is, okay, so I can value the equity, or I can value the enterprise, and then I can start comparing that with ratios like an enterprise value to EBITDA or an equity to earnings, so a price earnings ratio. I'll think about which discount rate I'd use for equity versus which discount rate that I'd use for all capital or the enterprise. So we can kind of build up a column, 2 columns effectively. One, valuing equity. What measure of income? What measure of balance sheet? What discount rate? Valuing enterprise. What measure of income? What measure of balance sheet? What discount rate? We want to make sure, and I'll kind of be emphasizing this point, we want to make sure that we are consistent with what we're doing if we're focusing on the equity holders versus all value, so all financiers, so the enterprise. So that's kind of where we're going in the next couple of weeks. But no, so that was a good question, Mitch, because if I couldn't show you that, then you'd be quite right to say, like, great that we learned how to do a few ratios, but where is this going? So hopefully that's given you at least a sense of where we're going to be using these sorts of ratios. So we'll be using these ratios that we're thinking about directly in terms of building up a valuation. And so I might say, look, I'm giving you an overall profit margin here, but that profit margin forecast might come from thinking particularly about cost of goods sold and also their selling and general expenses, I may not be worried too much about their advertising and so on. So I can build this up in a number of different ways, and you'll see. So for example, for say my revenue growth for JB Hi-Fi, I've been thinking about, do I think they're going to add any stores? Do I think their stores are going to become more effective? What do I think is going to be the online sales growth rate? Looks like this number that I've got here is 10% online sales growth for JB Hi-Fi in 2023 is massively overestimating it based on what they told me in the sort of the first half yearly reports. Looks like it's going to be closer to 0 or negative, which I wasn't expecting. So the way management are describing this is everyone's coming back into the shops. So they had a huge spike in online sales through COVID, and now it's it's still higher than it was pre-COVID. It's not going to be as a percentage gain, and so on. So that's where we're heading in the next couple of weeks. So hopefully that's kind of at least laid out some of how we're going to be using these ratios and why it might be helpful to be thinking about these types of ratios going forward. As usual, happy to hang on if anyone's got any other specific questions. I'm also, now that we're kind of getting into the meat of the project, don't hesitate to, as I said, bounce me an email and say, look, I'm not sure about X. And sometimes it's going to be a kind of a quick one. The picking up the row that we want on, say, shareholders equity is kind of a great example where that's likely to affect a lot of people. So it's kind of always good that question got posted up on the forums. And again, kind of, because often those ones I can pick up pretty quickly because I've made every mistake you can make in going through these things. So I know, here's my mistake checklist to look through. Okay, let's just check them, yada, yada, yada. If you want to sort of just jump on a Zoom call at some point, I'm going to be more than happy to do that. Other than next Wednesday and Thursday, I'm going to be down in Canberra doing some work. And I think I mentioned last week that I'll kind of just be dialing in from a hotel down in Canberra next week, but I know they have Wi-Fi and I've got a hotspot on my phone, so we'll all be good. So other than kind of Tuesday afternoon through to the end of Thursday, Wednesday night could be okay, but if we can try and avoid those, that's fine. Other times, as I said, if you can avoid usually 5 to 7:30 p.m., that'll be helpful for my kind of dad commitments. But otherwise, yeah, as I said, more than happy to jump on, and sometimes that can just be easy to resolve any questions or issues that you have in a kind of a 5, 10, 15-minute call rather than you kind of fretting over something, because sometimes it can be just a really quick explanation. Go, oh, okay, yeah, that makes sense. So I'll hit stop on our recording button now.